President Joe Biden and House Speaker Kevin McCarthy struck a deal over the holiday weekend to suspend the $31.4 trillion debt ceiling until January 1st, 2025. Joining us right now to talk about this push on Capitol Hill for support for the deal before June 5th, which is the ex-date for default, is Krueger. He's Washington strategist at TD Cowen Washington Research Group. And Chris, thanks for being here. Look, we know this could be a little messy, but I think you're assuming that this will get passed before June 5th, correct?
Correct. That's our base case, that this will be handled by next Monday, which is June 5th. Probably the first test case will be this evening with the House Rules Committee. You do have, 3 of the 9 Republicans on that committee are members of the Freedom Caucus. 2 of them will be opposing it in committee. But it sounds like sometime this evening, maybe around 8 p.m., the rule will be passed out of the committee. There'll be a vote tomorrow after market hours in the House, probably, 10 p.m. And then in the Senate, it's largely just a question of when, not if. And if the Senate really wants to work all the way through the weekend, they can. But with Yellen pushing the ex-date out 4 days, that really gave lawmakers the air pocket they needed to land this plane.
So let's talk a little bit about what's in it. I take it you've read the 99 pages. 2 years of discretionary spending caps. It pushes out the debt ceiling hike until January of 2025, permitting reform, clawback of pandemic funds, and work requirements for programs like SNAP. What does this mean for the markets?
Well, the big news is that the debt ceiling is raised until January 1st of 2025. And extraordinary measures are backfilled. So in reality, we probably won't have to deal with this for 2 more years. Candidly, the other issues in the bill, there's not a whole lot there for markets, with the exception of a boost in defense spending of around 3.5%. And then also within energy permitting reform, there's not a ton in there, with one big exception, and that is the Mountain Valley Pipeline being approved. So those are probably the 3 big issues that markets would care about.
The one thing I will say is the last time this happened back in 2011, where there was some austerity that was kind of built into things, we've talked to other people and they pointed out that it was a little bit rougher for the markets than people had anticipated because of the cut in federal spending. Is that going to be the case with this bill, or are the cuts not as meaningful because it's cuts based on estimated growth, not actual growth from where we've spent in the past?
Well, there are probably 2 big changes. The first is that the discretionary caps for this year and then a 1% growth rate for next year, that doesn't have an inflation adjuster. So if inflation's, call it 4%, 5%, you are talking about net fiscal drag there. And the other issue is what happens early next week with the credit raters. If you look back at 2011, that deal had real austerity, had real deficit reduction. This deal, candidly, doesn't have any deficit reduction. So that is a question with debt to GDP levels, the highest they've been since 1945. But that's another question for another day.
Okay. What overall would you say that you'd advise people, other than defense might be the only place that you see some real play for Wall Street?
Well, and, getting the pipeline through, the energy permitting reform is included as well. Probably more than anything, though, this is, the biggest self-created DC tail risk you can have. And this is now off the table for the next 2 years. A government shutdown in the fall has also been de-risked a little bit because now you have those discretionary caps in place. So for all of the risk that DC has created over the past couple months, we now have a pretty smooth pathway in DC from a market standpoint.